So let's start. There are 3 doors. Let's pick a door. Let's pick door number 1. Well, you don't want door number 1, because door number 1 is if the Federal Reserve raises rates too quickly. If you have a systemically weak economy, if you raise rates too quickly, you threaten to send the economy back into recession. You could create deflation and higher unemployment. This is bad for the equity markets and all capital markets. So let's pick another door. Let's pick door number 3. You don't want door number 3 either, because door number 3 is if the Federal Reserve raises rates too slowly. If they raise rates too slowly, you risk creating inflation and asset price bubbles like we've gone through with the last financial crisis. Also, if that were to happen and you had high inflation, the Fed may be forced to raise rates quicker than you would like. So, and this again would be bad for investment returns. The door you want is door number 2, and that is a slow unwinding of monetary policy where you're going to have low inflation for a longer period of time. Interest rates, while they may move higher, will stay low versus other policies in the past. This is good for investment returns, and we think this is actually the door that you're going to see. So why do we think that? Well, let's look at some of the economic variables. We're going to start off with the unemployment rate. The blue line, you can see unemployment rate topped out in the recession around 10%. Presently, we're at 6.7%. So you've seen it move down a fair bit. The Fed has recently indicated that they had a target for the unemployment rate of 6.5%. At that point, they would start to consider raising interest rates. They've backed away from that, and why? Because that 6.7% is deceiving. You would think by looking at that the employment market has improved a lot, but there's still a lot of weakness. If we were to look at, again, the red line is that same unemployment line, but we were to overlay it with this blue line, which is the labor force participation rate, which is the percentage of the labor force employed or actively looking for work, you can see that it also has been moving down. In fact, right now, or rather it hit a high in March of 67.3. The 30-year average is 65.7, but in December it came down to 62.8. Now, part of it is demographics, baby boomers retiring, leaving the workforce, but what it also is that people who are unable to find a job leave the labor force, and that decreases the participation rate. If we were to take the 30-year average and apply it against today's market, the unemployment rate would be 10.8%. So again, that 6.7 is very deceiving. Some other things that the Federal Reserve is looking at is the long-term unemployed. 37% of the unemployed have been out of work for more than 26 weeks. That's about 4 million people. It should be about 2 million. So a lot of these people have been unable to find a job for a long period of time. A lot of these will never find a job ever, and they'll end up falling out of the labor market and also further depress that participation rate. So that's another concern. If you were to add to the unemployment rate people that are marginally attached, these are people that have looked for jobs maybe once or twice in the last year but aren't working right now, or people that are working part-time but they really want to be full-time. If you add those to the unemployment rate, you get 12.7%. So again, a very high number. Probably the most disturbing number, though, is the youth unemployment rate. It's around 14%. And we risk losing an entire generation of workers that may never get the skills they need to get good full-time employment. Now, another thing, if we look at where we lost jobs in the recession and where we gained them in the recovery, this is a chart from the National Employment Law Project back in August 2012. You can see where we lost jobs was in the middle-income occupations. We lost about 60% of the jobs came in this category, only 22% of the gains in the recovery. Where we gained jobs was actually in the low-income occupations. We only had 21% of the jobs lost during the recession, but 58% of the gains. So again, the jobs we've created have been low-paying jobs. Now, what this means is that you look at the middle class, and like the snow leopard and the bluefin tuna, the middle class is getting squeezed. And part of this is a long-term impact. It's not just a recession. It's been happening for a number of years, globalization and technology being some of the main causes of this. In fact, an anecdotal comment, in 2012, Kodak went bankrupt. At its peak, it employed 145,000 people. Facebook recently paid $1 billion for a company called Instagram that was partly responsible for putting Kodak out of business. It only has 13 employees. So we are creating jobs, it's just we're not creating enough jobs to make up for the jobs we're losing. Now, the other concern with this is that, yes, we're creating jobs, but do we have the people to fill these jobs? Because these are jobs in new technology, and we don't necessarily have the skills with our present workforce to fill those. In fact, 45% of US companies cite lack of skills as a common reason for job vacancies. And a McKinsey Institute also points out that why this is going to take a long time to play out is because even if we have the jobs available, we're not training our workers in the correct way to fill those, our young people. And you look at, for science, technology, engineering, and math graduates as a percentage of total college grads, worldwide it's about 23%. China is doing very well. They're about 42% of their graduates in this area. The US only 15%. Canada a little better at 21%, but still fairly low. So you can see that not only do we have a skills gap, we're not doing enough quick enough to train these people for these jobs. And it's why we think door number one is not the one the Fed will take, because there still is a lot of weakness in the job market that they identify. So now let's look at inflation. This is showing inflation, core and headline inflation. The black line, 2%, is the Fed's target rate. They want to get to 2% inflation rate. Unfortunately, you can see headline and core inflation is substantially below that. So you're seeing inflation not even close to that target. And actually, the Fed is paranoid and more worried about deflation than inflation at this point. In fact, they see deflation everywhere. What do I mean by that? Have a look at this chart. This is a picture of Paul Volcker. He was the Fed chairman in the 1980s during the Reagan and Carter administration. He was remarkably a tall man, 6'7" tall. After him came Alan Greenspan, 5'11". Then you had Ben Bernanke, 5'8", and finally Janet Yellen at 5 feet. You see a disturbing deflationary trend. Now, I would say that the Fed, Janet Yellen's going to be in power for 4 years at least, but you got to wonder, what do you do next? And I'm just saying. So we don't think deflation is an issue. In fact, we see the potential for an increase in inflation. The green line is wage growth, and you can see that wage growth has been falling during the recovery. You can't have inflation if you don't have wage growth. It's one of the key drivers. So this is what everyone's worried about. There's no wage growth. In fact, you could have deflation. But if we overlay this graph, or this line, with the yellow line, which is from the National Federation of Independent Business, it's their Positions Hard to Fill Index. And you can see from this, at least about 25%, one in four small businesses have had trouble and have highlighted vacancy as being an issue, and why they have, and because they've had no qualified applicants. You can see that line moving up. You can see the correlation between wage growth and this hard-to-fill index is pretty positively correlated. It would indicate that you should start to see wages increase as well. In fact, we've seen that happen. Now, the other thing sort of related to this is short-duration unemployment. I said that the unemployment rate was 6.7%, but the long-term unemployed, those 4 million people, that's about 2.5% of it. So 4.2% are short-duration unemployed. In other words, they've been unemployed for less than 27 weeks. It's this group that influences wage growth, not the long-term unemployed. They're never going to get a job again. They're not the one influencing wage growth. So at 4.2%, this is the lowest since April 2008, so it's quite low. The average since 1948 is 4.8, so it's below the average. And the New York Fed estimates full employment is actually 4.6%. So this would indicate that, again, you should see wage growth continue to move higher. And another thing on inflation, one of the other aspects that's been moving lower as well as wage growth has been food inflation. You can see it moving down over the last few years. Just recently, we've seen that move up. And in fact, the US Department of Agriculture expects food prices to go up 2.5% to 3.5% this year. So bad for us, good if you're worried about deflation. One last one, medical cost. It's also been moving lower, and it's also been starting to move a bit higher. And this is a major component of consumer price index, is medical costs. And we think with the rollout of Obamacare, this should again continue to move higher. So overall, we don't see door number 3 either. We think door number 2 is the most likely, which is this slow unwinding of monetary policy.